All right, guys, welcome back for another video. I just want to give an update to Bitcoin trade I'm in. So still in the long position I took, 429 Bitcoin from the FOMC lows right here in September. The Federal Reserve did raise interest rates, but a lot of times, when the Fed comes out and they raise interest rates exactly as predicted, that actually can be a bullish thing and spur a relief rally because uh, a lot of the market was risk off going into the meeting, hedging themselves against the possibility of the Fed raising rates more than expected and that bearish, uber bearish scenario playing out. So when the Fed comes in, does exactly what they said they were going to do, it relieves a lot of the uncertainty around the market. So naturally, you get relief rallies. And if you go, just go back, after the July FOMC meeting, I don't know if it was here, may have been here, somewhere in here. The Fed raised interest rates, and then you get a rally. And the same thing happened in April, and a little bit in May too. Excuse me, March, and then a little bit in May. So it's very characteristic of those FOMC meetings to put in a relief rally. And a lot of people also are getting very bearishly positioned around those FOMC rallies. So anytime the market gets overwhelmingly bearish, uh, the market typically squeezes the bears, and that's generally what we see. But I just wanted to mark off this range right here. So that FOMC in September came out right here. So you get the data release, and then you get liquidity run to the highs above here. So the stops above here are taken out, and then you get a liquidity run below here, below lows, liquidity runs taken out. So this is generally what you see before a big move, right? At a high time frame level, you see the volatility expansion and then a contraction. So what's happening here is the market is grabbing liquidity before it's making its move. So and a lot of times in those scenarios, you get what I call a whiplash pattern. So uh, you know, traders on both sides of the intermediate time frame consolidation get taken out, and then you get a volatility contraction, and then price spikes above this high. Well, it doesn't necessarily have to run the highs, but in this case, it did choose to run to the upside. Then you get a change of behavior, right? You get this whiplash effect, and runs liquidity on both sides. It really doesn't matter that it ran the highs first and the lows second. It doesn't really matter. It's just a whiplash. It's not really bullish or bearish, right? It doesn't matter which high or low it ran. What matters is after you get the whiplash effect and then you get the volatility contraction, where does price reach for liquidity after that? Does it go for the downside or the upside? Because really, this is the type of pattern you see before a change in market behavior, right? The whiplash, volume contraction, and then expansion. And if it starts running for the highs, especially coming off a downtrend, well, that's typically a change in behavior. And so now the market is running for liquidity above the highs as opposed to below the high or below the lows, right? If this was going to continue a downtrend, you probably would have seen price run back below these lows right here and then maybe run up into the range a little bit before moving lower. But that's not what we saw. We saw price run above the highs, change behavior, slams back down, but it did pull in that liquidity, right? So, uh, stop losses are getting run multiple times, right? So you have this high right here gets taken out, the stops above here get taken out, and then this push up here just runs just above the high right here, takes them out. Now, what I want to mention here is I want to go back to the daily and talk about the distinction on the daily chart. Now we have this range right here identified by the FOMC high and low. Right there. And, we can describe this as the trading range. Now, again, if we look at the RSI, a lot of your RSI is going to be confirmed breaking above this range, right? A lot of it is unconfirmed. But you see the RSI turning around as price is making lower lows. RSI is making higher lows right there. You can see the same distinction on the 3-day and even the weekly too. Now look at the 3-day chart. That's just totally beautiful. But the distinction I want to bring your attention to is the right here. So we've identified the range marked by the FOMC trading range. from this high to this low. Now, what I want to talk about is do you consider this range broken when it's traded above or when you get a close above? And there's really no right answer to that question. Personally, for me, I would use this, and I'll kind of explain a little bit more on that. But some people may have seen this take out the high above here, close much lower on this day, right? Run above all the way up to 20,300, close back down. A lot of people would interpret this as a bearish rejection, um, if for a number of reasons, but I wouldn't do that. I wouldn't necessarily wait for the close above. I would be looking at this break of liquidity above. Again, we'll go down in the lower time frame just to kind of hash that out a little bit. But I do think it is important, right? Because you get this run above, so you do get a 4-hour close above, right? So it's kind of, you can always find anything on any time frame to justify your bias, right? But if you're looking purely through liquidity concepts, then the time frame, the close on each individual time frame is a little bit less important, and what's more important is price action itself, right? Price is price is price. And it doesn't mean that monthly or weekly uh, levels aren't important, but if you've got, but they are important in liquidity context, right? So if you have a daily high, a daily low, a weekly high, a weekly low, a monthly high, a monthly low, if those highs or lows get ran, but you don't necessarily get a close above them or a close below them, I still view that as very significant, right? I don't put a lot of weight on closures. Now, a lot of people do, and a lot of people, make money doing that, but it's just not personally my way of trading. It doesn't mean that I don't think closures are important. They certainly do have significance. My own personal opinion is that people tend to overweight their significance. So it's a little bit nuanced, right? Because people tend to go one way or the other. They either say everything's, it's more significant than it should be, and then some people say they're not significant at all. I just think they're kind of, overemphasized a little bit. Anyway, when I saw this, I would see this broken to the upside, and then you get test back down, run below these lows, run back up into this consolidation, another volatility contraction, run above the highs. Now, this kind of ties into the swing failure pattern I wanted to talk about. I marked off this low right here, and the basic idea is, and this is important, where you get a closure that ties in to what we're talking about. So anytime you get a close above this significant high that we've identified, you can trade the retest. It's typically a tradable scenario. Most times when you get this close above, and then price retraces off the open right here, which in this case was at 20,300, tests back into basically 20,000, this high right here. That's a very tradable price distinction. A lot of times you'll see price, even if it doesn't continue dramatically, at least bounce off that level, right? You typically see that type of behavior, right? You get the close above, the open, the test down, and then the bulls push price back up above the high right here. So that is a very characteristic price pattern. It typically plays out a lot. Now, what happens after that is very important as well. And this low on the retest is also very important. So if this were to become a swing failure pattern, this would be the area I want to look at, right? That intermediate time frame low that's created after the retest. So once you get that, then you mark that level off. Now, if this is going to be a successful retest, right, a close above, test down, the type of price behavior you would be looking for is for price to move pretty dramatically, right? We don't want to see price hang out around this level, right? You want to see a close above, a test back down, a push up, and then a relatively quickly, regaining its ground. And already today is, taking out these highs, but, again, we want to see price, extend much higher and after the retest and push up. Again, we don't want to see price hanging out at this level after the close above if we're worried about a swing failure pattern. And on on the contrary, if this intermediate time frame low that's created, again, this is the test back down into the previous high. So this high right here coming from over here was the high of the FOMC meeting back from September. Then we get the close above, right? And then test back down into this previous high from FOMC. And then we set in an intermediate term swing low. So anytime you get that behavior, again, it's everything in combination, right? The close above the old historic high, the retest back down, the intermediate time frame low, the bounce off. You know, even ideally, if you go down to a 15-minute, you'd want to see it bounce off this high and then, start taking out the highs on like the 15-minute chart or whatever. But point is, you have the swing low formed off the old historic high. So if price were going to create a swing failure pattern, this is the significant low, right? If this low gets taken out, then it would start to look more and more like a swing failure pattern. And the reason why I mention that is because that's an area where I'd really be looking to manage risk. It's a great area to manage risk, in my opinion. The reason why it works so well is because, a lot of people, maybe they're breakout traders, they entered along maybe at the close above this high right here. And a lot of those breakout traders, they probably enter above the range break and then have like a stop loss below the range lows. So in that scenario, you start creating the swing failure pattern actually when you take out this intermediate time frame low. So that's where I would be managing risk because, in my opinion, if we do take out this level, then you start to create a swing low pattern, right? This is a liquidity run up above these highs to trap long traders up here before creating the swing failure pattern and then probably running liquidity to the downside. Now, whether that means, running this one, and this one, or just this one, or how price runs for liquidity to the downside, it's very difficult to predict exactly how that will happen. So there's really no point in doing that, but probably what you see is something like, this area gets taken out, then now the market's in downside liquidity search. It will probably then run for these lows here, maybe take these stops out here, bounce a little bit, maybe consolidate, and at that point, either probably run for the lows again, before, getting ample liquidity, and then who knows, right? Because this still is a very high time frame level. So I do, I'm not really looking for the floor to drop up on Bitcoin because, really Bitcoin capitulated in June, right? There were more realized losses taken in Bitcoin in June 2022 than in any other time in Bitcoin's history. So, and at the same time, you have this macro backdrop of people, being incredibly afraid. They think the financial system's going to explode. But meanwhile, you already had the capitulation, right? So I'm not looking for the floor to drop out. But that doesn't mean the price can't run liquidity to the downside, right? And in that case, if the market gives you the opportunity to manage risk and profit, which it's been doing for me here. Again, I took this position from down here, really a great entry with a very large position size, 429 Bitcoin, almost $1 million in profit, even right now, and price hasn't really even began to run yet. But even though I'm deep in profit, I don't want to get greedy. I am going to manage risk at this level and not manage the whole position. I never manage an entirety position based on a static stop because you really don't know, right? I mean, as well identified as these levels are, there's a certain amount of randomness in price. So price could always come down, take out my stop, and then run up. which is why I never want to pick a static line in the market where the market, makes me go all or nothing, right? I'd rather manage the position dynamically and always, only take a fraction off and then manage it over time. So again, that's a little bit more nuanced, but basically the idea is that, but on the flip side, if that level gets hit, then my mentality will shift to risk management mode on looking to manage risk. And, I always want to think about it in terms of fractions, because at the end of the day, you don't know for sure, right? You could always get stopped out, and then the market goes in your favor. In which case, you can just there's also opportunities to add risk as well. But you got to be patient for those. You got to wait for the opportunity, and really, that's just 99% of trading, right? It's just waiting for the opportunity, and then setting things up, and then just most of it is 90% is waiting, right? And letting time play in your favor. Anyway, I hope you guys like this video. If you guys haven't subscribed to the channel, please just subscribe below, and I'll catch you guys in the next